What's going on, dividend chasers? Dividend Bloodhound here with another investing episode. Today's episode we're talking about the best high yield dividend stocks that you can buy on the market today. Hopefully this video does bring you some value. If that is the case, then do please consider hitting the like button down in the corner here somewhere, and consider subscribing to the channel as well and ticking that notification bell so you get notified of lovely content just like this. That being said, roll the intro and I'll see you on the other side. Catch you there. Hey again guys, welcome into the video. So as I said, today we are checking out the best high yield dividend stocks that you can currently buy on the market. I've got a US and a UK stock as well for you to look into, just in case you're from either country. And all of these are extremely high yielding a minimum of 7%. High yield stocks do come with a word of warning. High yielding companies, typically it does indicate poor health of the company, because a yield going up means that usually that the share price has came down. So when you're looking into high yielding companies, you have to have a look and be certain of the financial health of the company. Usually if investors have taken flight from the company, there's a reason why. Has it reported poor quarterly results or consecutive poor quarters? Is revenue on the decline? Have they had a significant bad news scenario in the news? All sorts like this can affect the company's share price, which pushes the yield up. It's not always a good thing, especially as us dividend investors can get a scoop in at a lower price and get a better yield out of it, but you have to be confident in your research for that. As I mentioned, it is extremely important to do your research when you're looking into these companies. I've selected three here that are high yielding, but they are quite safe, and their dividend is more than covered. They can all afford to pay it 1.3 times over as a bare minimum, and their payout ratios do not exclude or go over 100%, which is obviously an excellent thing. One last quick note before we actually get into looking at these companies is, do not fall into the high yield trap. This is when a company tries to maintain its dividend, the yield is plus 10%. It almost looks too good to be true, and you think you can make your money back on this investment really quickly. Now you've got to be so careful with that, because they'll lure you in with that high yield and then they'll cut the dividend and they'll cut right back, and then you'll be left, the share price will plummet and you'll be left holding the bag essentially, while all the other investors have got out, and you're left with a low share price. So you've lost money that way and no dividend, so you've lost money twofold, and there's no way of getting that money back, at least in the short term. So do be careful when you're looking into high yield companies. That is absolutely for certain. Do take this away from the video. Our first company today you will have 100% heard of, and that is AT&T. They're significantly reduced in share price at the moment, just the $29 a share. I love this company. It's one of the biggest holdings in my portfolio, and it certainly is my biggest dividend payer. It's got a great history of over 35 years of raised dividends. Even if it doesn't raise it a lot, it's still consecutive growth, and it has a massive yield on it at the moment of over 7.1%. So that is a fantastic return on your investment, and the dividend is considered quite safe as well. That being said, let's get into the app and let's have a look at how this company is doing and how its fundamentals are shaping up. Catch you on the other side. What's going on again, guys? Here we are with AT&T then, and as mentioned, $29 share price, down in the middle of the pandemic from a peak price of $38, $39 over the last few years, over the last year or so should I say. So there's $10 in it per share at the moment. I believe it is a great time to buy into this company. The dividend is safe and considered safe by most analysts. It has a dividend cover of 1.7, so it can pay the dividend almost 2 times over, and its payout ratio is 58%, which is also considered quite low. Anyway, let's have a look at the other fundamentals. So its ticker is T, as we've already seen. CEO is John Stankey, and it is in the services, internet services and mobile service communications sector. Has a market cap of $206 billion, a PE ratio of 13, revenue of $181 billion, earnings per share of $2.23, and a dividend yield of 7.17%, which I think you will agree is absolutely huge. They have a net income of $13.7 billion and a profit margin of 7.67% and a low debt to assets ratio of 66%. Now if we hop on over to the growth metrics, we can see that revenue growth is still growing, even though this is such a mature company. Over the last 3 years, the revenue has grown 6.5%, and over 5, 3.5%. Compound annual growth rate is in double digits at 12.68%. That is great. And it has a 3-year dividend growth factor of 2%. So that's not massive, but when you consider that it's been growing it for 35 years, that is quite a comfortable growth part in the in terms of this stock. As long as it grows each year, as an investor, I am pretty happy with that. This is one of my favorite companies, and my plan with this one is to get to a point where I can buy an extra share in the company per quarter that it pays its dividends. So I need approximately £23 at the moment from this company to buy another share in the company. That being said, I'll see you back in the outside world. Hey again guys, welcome back. That was AT&T there. As I quickly said, my plan was to get to such a point that every quarter I can buy an extra share in this company. I need about £2,000 worth of AT&T to do that, which roughly equates to 88 shares. I'm on 22 at the moment. So the plan is getting there, but I need to consistently carry on building. Anyway, moving forward, our next company is a dividend king, and that is Altria. Now you're going to have to hold on with this one, because obviously there is an ethical issue in owning a tobacco industry, because ultimately some of this company's products do harm people. But that, if you're prepared to put up with that and that your conscience is clear, then this also is a pretty good investment for you to look into, and also has an extremely high yield as well. Something that you guys might not know is that Altria has a 10% holding in InBev, or the company that owns Budweiser. So they've diversified in that respect, that they own a portion of that company. They own a Michel wine brand, which is also further diversification. They own a 55% stake in Cronos, a Canadian marijuana manufacturer. As we know, the marijuana industry is growing, so that will provide an extra little bit of growth to this company, because we all know that the tobacco industry is sort of on the decline in some countries as people are becoming more aware about their health and moving away from smoking. And last but not least, they own a 35% in a Juul vaping lab. So that is again another big thing that people have moved to lately. That is a massive growing sector. Vaping instead of smoking is a big in thing at the moment. So that is something that the company is looking to take advantage of. Now that being said, let's actually get in and have a look at Altria's fundamentals, because I do believe that this company can continue raising its dividend and pay this high yield, which is over 8%, well and safely over the coming years. So it's definitely one to look into for your portfolio. Let's get in there, let's have a look. Hey again guys, welcome into the app. So here we are checking out Altria. A little bit down at the moment, which is why the yield is so high. My investment is 12% down, or £17, but I have been paid quite a few dividends since I've owned this company. So current share price is $40, came down since the pandemic from a high of $50 a share almost, and it's recovered back to about 44, and then it's just dropped off again recently down to 40. So the fundamentals then, its ticker is MO, the CEO is William Gifford. They have a market cap of 81.84 billion, a PE ratio of 14.79, revenue of 25.11 billion, EPS of $2.98, and a dividend yield of 7.81%. Net income of minus 129 billion at the moment. That was from 2019, however, and a minus profit margin of 5.15%. You've got a debt to assets ratio of 87%. And if we hop on over to the growth side of things, we can see that the revenue has stayed consistently the same. It's not really grown a lot, but neither has it diminished too much either. Minus 0.83% over 5 years, and actually has grown a touch over the last few years. It's not the sort of growth that you're going to write home about, but it's still a little bit of growth, meaning that there's still life in this company yet. Compound annual growth rate is also 6.74%, which isn't too bad. And then we have a 3-year dividend growth rate of 20.97%. Now that is pretty good indeed. The dividend is covered 1.3 times over. So that to me suggests that it is pretty safe, as they can afford to pay a third of the dividend again each time they pay each quarter. And the ratio of payout is 80%. So they've still got some spare money left over afterwards, which is great by anybody's books, and means that this yield and this dividend king can continue to raise its dividend and pay its dividend in the next few years. I'll wrap up here and I'll see you back outside in the real world. Hey again guys, welcome back to the real world. So that was Altria there, a dividend king, the only dividend king that I'm going to present to you today. But with such a high safe yield, it just cannot be ignored. A 7.5%, but over a 7.8% return on your investment each quarter is absolutely fantastic. We know that it is pretty safe as well. It's covered a third again from what it would be paying, and I've got a lot of faith in this company. As you can see, I am invested in this company. I'm invested in all three of these companies that I'm showing you today. So I've put my money where my mouth is. And yes, it's declined a little bit and I haven't averaged it down. But if I had the spare cash, I definitely would, and get an even better return on what is already a pretty good investment. The one thing that does concern me is the fact that the tobacco industry, in my opinion, is probably going to die off and slow down over the next 10 to 20 years or so. So maybe in a few years time it's going to be time to start looking elsewhere for my money in particular. But that, I could be wrong about that, especially with the growth of vaping and what the other things that this company is invested in, the marijuana and it being in Budweiser as well. There's all sorts of things that could still make this company a significant amount of money. Moving on to our final company then. It's a British element, because I have to include a British stock in each one of these now, especially as I'm from the UK myself. And that company is Legal and General. It is a huge insurance and investing provider over here in the UK. Has again an extremely high dividend yield to pay out, but it is safe, very safe, and that is what I'm trying to bring towards you guys so you can have a look at them for your portfolio. This company has again an 8 to 9% dividend yield, but it is the best covered dividend that I've presented you today. Legal and General can afford to pay this dividend almost twice over, a ratio of 1.8, so they could almost pay it twice every time that they do come to pay it, which is really sustainable and fantastic for the long term. That being said, let's get in there, let's have a look. Hey again guys, welcome back into the app. So here we have Legal and General at £1.92 a share. Pre-pandemic it was £3.19, so there's even a significant upside for you in this company as it returns back to the share price that it had before. It will take some time with the amount of people that may claim from the pandemic, which is what I think has spooked investors from this company. So its ticker is LGEN. The CEO is Nigel Wilson. They have a market cap of £11.81 billion, a PE ratio of 6.34, revenue of 66 billion, an EPS of 0.31, and a whopping dividend yield of 8.88%, a net income of 1.83 billion, and a debt to assets ratio of 98%. This is high. Usually if this was another company you would be concerned about that, but this is in line with what you would expect an insurance company to have, because they manage a lot of other people's money. If we hop on over to the growth metric side of things, we can see that revenue has grown in the last 3 years by 5.5%, has declined slightly over 5 years, -3%, but they are seemingly through that as there's a positive in the 3 years. You've got a compound annual growth rate of 5.74%, which again is nothing to write home about, but pretty good and means extra growth for your investments. And then a 3-year dividend growth rate of 7%. But when that yield is 8.8%, you are making a significant ROI on your investments. And they've been raising this dividend now for 10 years straight, so it's starting to build significant history behind it, which is really good, especially for a British company. I really like Algen. I'm invested in it on my Freetrade app, and I really want to add more of this company as quick as I can, especially taking advantage of this low share price here and the dividend safety and dividend cover that they have of nearly being able to afford it twice over. That is a really good tick for me. That being said, I'll wrap up and I'll see you back in the outside world. Hey again guys, welcome back. That was Legal and General there, one of my favourite dividend paying stocks in the world essentially, but even factoring in US stocks to it, no one can beat at the moment the sort of dividend cover this company offers. Even though it only pays it every 6 months, it is absolutely fantastic to have in my portfolio and one that I'm looking to build into a considerable position. I only have the 60 shares at the moment, but that is enough to buy a share extra each time the dividend is paid. But I want to build this to a point where I can actually buy 10 shares each time the dividend is paid, which would require me to own about £500 worth of this stock, and that is a long-term goal of mine, to get to that point and then beyond, so it almost builds itself over time, which is what this is all about. I do hope you've enjoyed this video today. It's great to bring you some high yielding dividend stocks that are going to give you a great return on investment very quickly, so you can buy even more of these companies with their dividend. I hope you've enjoyed it. If you can see your way to liking the video, that would be absolutely fantastic. And if you haven't already subscribed, I would massively appreciate it if you could, and tick that notification bell as well. That would be super awesome. Hopefully I'll see you in another investing episode soon. Catch you later. Bye bye.